Over 70% of all trading on Wall Street is now executed by machines, not humans. Machines. Every stock you own, every retirement fund your parents built, every pension keeping a teacher or a firefighter alive in old age, the price of all of it is being set right now by algorithms running on servers in New Jersey. And on one specific afternoon, May 6th, 2010, at exactly 2:32 p.m., those machines nearly destroyed the entire American financial system in 36 minutes. Here's the question no one has fully answered. How did we hand over the world's most powerful economy to a set of mathematical instructions? And what happens the day those instructions get it catastrophically wrong? That answer will change how you see every number on every screen. The story starts not on Wall Street, it starts in a casino. 1961. Edward Thorpe is a mathematics professor at MIT. He is not rich, he is not famous, but he has figured out something that no one in the history of gambling has ever proven with hard mathematics. The house does not always win. Thorpe built a model, a set of rules based on probability, that told him exactly when to bet big and when to walk away from a blackjack table. He tested it in Reno, Nevada. He won, consistently, scientifically, not by luck, by math. Then he asked a bigger question. If math can beat a casino, can it beat the stock market? In 1967, Thorpe published a book called Beat the Market. It was 296 pages of equations that Wall Street largely ignored. But a small group of people read it very carefully. And what they understood, what the rest of the financial world missed, was that Thorpe had just written the instruction manual for the future of money. At the same time, something else was happening. In 1971, NASDAQ launched as the world's first fully electronic stock market. For the first time in history, you didn't need a human on a trading floor to buy or sell a stock. You needed a computer and a connection. Those two things, Thorpe's math and NASDAQ's wires, were about to collide. In 1977, a Hungarian immigrant named Thomas Peterffy arrived on the floor of the American Stock Exchange with a handheld computer. The other traders laughed at him. They called him the man with the machine. Within 5 years, his automated system was processing trades faster than any human being could physically write a ticket. He eventually built Interactive Brokers, a firm now worth over $35 billion. But Peterffy was just the opening act. Because in 1983, a man walked away from a $340 million government contract, moved to a small office on Long Island, and started hiring mathematicians, physicists, and code breakers, not a single one of them with any background in finance. His name was James Simons, and what he built next would make everything before it look like a child's science experiment. Remember the question from the opening, how did machines come to control Wall Street? We are about to watch it happen, step by step. James Simons was not a banker. He was a mathematician who had cracked Cold War codes for the U.S. Department of Defense. When he founded Renaissance Technologies in 1983, his pitch to potential investors was simple and terrifying. The market is not random. It has patterns, and we can find them. His team built what they called the Medallion Fund. They fed it decades of historical price data, every stock, every commodity, every currency, and they let the algorithm find signals buried in the noise. Patterns too small for any human to notice. Correlations between things that seemed completely unrelated. A shift in weather in the Midwest and grain prices in Chicago. A political speech in Tokyo and currency movements in London. The algorithm found these connections. It traded on them, thousands of times per day, in and out of positions in seconds. The results were not normal. Between 1988 and 2018, the Medallion Fund produced average annual returns of 66% before fees. To put that in human terms, if you had invested $1,000 with Simons in 1988 and left it untouched, by 2018 you would have had over $4.2 billion. No investor in history, not Warren Buffett, not George Soros, has come close to that number over that length of time. By 2018, Renaissance Technologies managed assets worth $100 billion. But here's what no one saw coming. Simon's success did not stay secret. By the late 1990s, every major bank on Wall Street, Goldman Sachs, Morgan Stanley, J.P. Morgan, had built their own algorithmic trading desks. They hired the same kind of people Simons had hired, physicists, mathematicians, computer scientists, people who had never owned a stock in their lives. In 1998, the U.S. Securities and Exchange Commission, the government body that oversees financial markets, approved a new type of trading network that allowed firms to execute orders electronically outside traditional stock exchanges. Speed became the weapon. By the year 2000, a new breed of firm had emerged: high-frequency traders. These were companies with one goal: execute as many trades as possible, as fast as possible, and collect a tiny profit on each one. We're talking fractions of a cent per share, but multiply that by millions of trades per day, and the numbers become staggering. In 2009 alone, high-frequency trading firms generated $21 billion in revenue. $21 billion, extracted from the market in a single year, largely invisible to ordinary investors. These firms spent millions laying fiber optic cables in perfectly straight lines between Chicago and New York, because a straight line is 37 miles shorter than following the roads, and 37 miles means 3 milliseconds faster, and 3 milliseconds on Wall Street is worth hundreds of millions of dollars per year. One firm, Spread Networks, spent $300 million on a single cable just to shave those milliseconds off their connection time. Stop. Before we go further, you need to understand something. This is no longer about investing. This is not about funding companies, creating jobs, or building the economy. This is a technological arms race happening inside the financial system, where the prize goes to whoever can move the fastest, and the losers are everyone who moves at human speed. By 2010, algorithmic trading accounted for more than 60% of all equity trades in the United States. And the system had grown so complex, so fast, so deeply interconnected, that not a single person on Earth fully understood what would happen if something went wrong. On May 6, 2010, something went wrong. At 2:32 p.m. on May 6, 2010, a mutual fund firm in Kansas City placed a single automated sell order. They wanted to sell 75,000 futures contracts, a type of financial instrument tied to the value of the S&P 500 index, which tracks the 500 largest companies in America. The order was large, but it was not unusual. What was unusual was the algorithm they used to execute it. It was programmed to sell based purely on trading volume, not price, not time, not market conditions. Just volume. The other algorithms on Wall Street saw the selling, and they did what they were programmed to do. They responded. They started selling too. Their selling triggered other algorithms to sell. Those triggered more. Within minutes, the entire market was in a feedback loop, a cascade of automated selling that no human had ordered and no human could stop. In 36 minutes, the Dow Jones Industrial Average, the most watched stock market index in the world, fell 998 points. That is the single largest point drop in a single day in the history of Wall Street. $1 trillion in market value disappeared. Shares of Accenture, a company worth billions, briefly traded at 1 cent per share. Shares of Apple briefly traded at $100,000 per share. Neither price reflected reality. The machines had simply lost contact with it, and then, as suddenly as it started, it stopped. The market recovered almost completely within 36 minutes of the crash. But the damage to trust, to the idea that these systems were safe, was permanent. Here's where we answer the question from the beginning of this story. How did algorithms come to dominate Wall Street? The answer is, one competitive advantage at a time. Each firm that automated gained an edge over firms that didn't. Each firm that got faster gained an edge over firms that were slower. The market rewarded speed and punished hesitation. So every firm raced toward automation, not because any single person decided machines should run the financial system, but because the system itself made that outcome inevitable. And the hidden risk? It's this. The machines are only as good as the assumptions baked into their code. They are trained on historical data, on patterns from the past. But the past does not always predict the future. And when something happens that the algorithm has never seen before, it does not stop and think. It executes, faster than any human can intervene. In 2014, journalist Michael Lewis published a book called Flash Boys. It sold 1.3 million copies in its first year. Lewis argued that high-frequency trading firms were not just fast, they were using their speed to front-run ordinary investors. To see your buy order coming, buy the stock a millisecond before you and sell it back to you at a slightly higher price. Millions of times per day, legally. The outcry was immediate. Congressional hearings began, the FBI opened an investigation, the SEC proposed new rules, and for a brief moment it looked like the machines might finally face real limits. But here's the part that should stay with you. The regulations that followed were modest. The high-frequency trading firms adapted, the algorithms got smarter, and by 2020, the share of trading controlled by machines had not fallen. It had grown to over 70%. Today, the firms at the center of this story look nothing like the Wall Street of the movies. There are no trading floors packed with screaming men in colored jackets. There are server rooms, rows of blinking machines in climate-controlled buildings, running 24 hours a day, making decisions at speeds measured in microseconds, 1/1,000,000th of a second. Renaissance Technologies still operates. James Simon stepped back from day-to-day management in 2010, but the Medallion Fund continues to run. Its methods remain so secret that employees must sign agreements preventing them from discussing the firm's strategies for life, even after they leave. Thomas Peterffy, the man who brought the first handheld computer to the trading floor, is now worth $25 billion. He has spent years publicly warning about the dangers of the very system he helped create. And Ed Thorpe, the mathematician who started all of this with a blackjack table in Reno, is now 91 years old. He has said in interviews that the financial system has become something he no longer fully recognizes. Here is why this matters to you directly. If you have a retirement account, a pension, or any investment in the stock market, your money is moving through a system where 70% of the decisions are made by machines in milliseconds. The price you pay when you buy a stock is influenced by algorithms you cannot see, running strategies you cannot access, operated by firms with no obligation to explain themselves to you. That is not a conspiracy. That is simply the market that was built, piece by piece, decision by decision, millisecond by millisecond, over the last 50 years. The deeper question is not whether algorithms are good or bad. The deeper question is this: when a system becomes so fast and so complex that no human can understand or control it in real time, who is actually in charge? On May 6, 2010, for 36 minutes, the answer was no one. The flash crash was fixed. The $1 trillion came back. The system survived. But the machines are faster now than they were in 2010. The strategies are more complex. The volume is higher. And the next time a feedback loop starts, the next time an algorithm triggers an algorithm, the question of whether it can be stopped in time is one that no one on Wall Street has been able to answer with confidence. We built a machine that could move faster than human thought. Then we handed it the keys to the global economy, and we are still waiting to find out if that was the right decision. The most powerful financial system in human history is not run by bankers or traders or governments. It is run by code, written by people most of us will never hear of, making decisions most of us will never see, at speeds the human mind cannot follow. If this story surprised you, subscribe. We release one of these every week.